Are you ready for the economic roller coaster of 2026? Most investors are scrambling, but a select few are secretly thriving, not just surviving. What if I told you there is a way to not only weather the coming storms, but to actually profit from the chaos? Stick around to discover the anti-fragile investor's blueprint. Welcome back to the channel. Today, we're tackling a topic that's on every smart investor's mind: how to navigate the unprecedented economic volatility we're anticipating for 2026. The old playbooks are being torn up. We're seeing a convergence of geopolitical shifts, rapid technological disruption from AI and automation, and persistent inflationary pressures that are rewriting the rules of the market. This isn't your typical market cycle. It's a fundamental restructuring. For the average investor, this uncertainty is terrifying. They see their portfolios swing wildly, driven by headlines they can't control. They're trying to time the market, selling at the bottom and buying at the top, driven by fear and greed. But for the informed investor, this chaos is not a threat. It's an opportunity. The key is to stop thinking about predicting the future and start building a system that benefits from unpredictability. That's where the concept of anti-fragility comes in. You've probably heard of resilience. Being resilient means you can take a hit and bounce back to your original state. It's like a rubber ball. You drop it, it deforms, but it returns to its shape. That's good, but it's not great. In a world of constant shocks, just bouncing back isn't enough. Anti-fragility, a concept popularized by Nassim Nicholas Taleb, is the next level. An anti-fragile system doesn't just withstand stress and chaos. It gets stronger from it. Think of the human immune system. When exposed to a pathogen, it doesn't just survive. It learns, adapts, and becomes more robust to face future threats. That's the mindset we need to adopt as investors. We want a portfolio that doesn't just survive a market crash, but actually gains strength, positioning us for even greater returns when others are running for the exits. The goal is to move from a position of defense to a position of offense, using market stress as a catalyst for growth. This is the fundamental difference between the investor who is merely surviving and the one who is truly thriving. So, how do we build this anti-fragile portfolio? It's not about finding one magic stock. It's about constructing a strategic framework. I call it the anti-fragile portfolio blueprint, and it rests on three core pillars. First, the barbell strategy. This is the heart of anti-fragile investing. Imagine a barbell with weights on both ends and nothing in the middle. On one end, you allocate the vast majority of your portfolio, say 80 to 90%, to extremely safe, conservative assets. Think of things like short-term government bonds, treasury bills, or even just holding cash. These assets are your fortress. They won't make you rich overnight, but they are incredibly robust against market crashes and preserve your capital. They are your defense. Now for the other end of the barbell. You take the remaining 10 to 20% of your portfolio and allocate it to highly speculative, high-risk, high-reward ventures. This is your offense. This is where you have the potential for explosive, non-linear gains. We're talking about investments in early-stage tech startups, venture capital funds, cryptocurrencies, or option strategies designed to profit from extreme market moves. The key here is that your downside is strictly limited. The most you can lose is the small percentage you allocated. But your upside is potentially unlimited. This structure ensures that no single black swan event can wipe you out, while still giving you exposure to massive opportunities. You avoid the mushy middle, those medium-risk investments that get crushed during volatility without offering exponential upside. The second pillar is radical diversification. I'm not just talking about diversifying across stocks and bonds. I mean diversifying across asset classes, geographies, and even strategies. An anti-fragile investor owns a piece of everything. This includes real assets like real estate and commodities like gold and silver, which often act as a hedge against inflation and currency devaluation. It means looking beyond your home country and investing in emerging markets that have different economic cycles. It also means diversifying your strategies. You might have a long-term value investing strategy running alongside a short-term trend-following system. This way, no single market event can cripple your entire portfolio. When one area is down, another is likely to be up, creating a smoother, more robust journey. The third and final pillar is a cash reserve and optionality. In a volatile world, cash is not trash. Cash is king. Holding a significant cash position isn't a sign of fear. It's a strategic weapon. It provides you with what we call optionality. When markets panic and everyone is selling, assets go on sale at fire sale prices. This is when the anti-fragile investor, armed with cash, goes shopping. That cash reserve allows you to seize opportunities that others who are fully invested and panicking are forced to miss. It transforms you from a victim of market crashes into a predator. This optionality is the engine that allows your portfolio to get stronger from shocks. Now, let's get into some specific tactical plays for these turbulent markets. These are actionable strategies you can use within your anti-fragile framework. First, let's talk about volatility itself. Most investors fear it, but the anti-fragile investor can trade it. Using options, specifically buying long-dated puts on broad market indexes like the S&P 500, can act as a form of portfolio insurance. These positions are part of your speculative barbell. They are relatively cheap to hold during calm markets, but their value can explode upwards during a sudden crash, providing a massive cash infusion right when you need it most. This is how you literally get paid from chaos. Second, focus on companies with pricing power. In an inflationary environment, the ability of a company to raise its prices without losing customers is paramount. These are businesses with strong brands, unique products, or dominant market positions. Think of luxury goods companies or essential software providers. They can pass on rising costs to consumers, protecting their profit margins and making their stock a reliable performer during inflationary periods. Third, embrace asymmetric bets in technology. The pace of technological change is accelerating. Areas like artificial intelligence, biotechnology, and decentralized finance are creating entirely new industries. Investing a small portion of your capital in a diversified basket of innovative companies in these sectors offers incredible asymmetric upside. Many will fail, but the one or two that succeed could generate returns that dwarf all the small losses combined. This is the essence of the speculative side of your barbell strategy. And finally, never underestimate the power of rebalancing. Your anti-fragile portfolio isn't a set it and forget it system. It requires active management. After a market shock, the allocations will be out of sync. Your safe assets might have held their value while your speculative assets crashed, or vice versa. Rebalancing means selling some of the assets that have performed well and buying more of the assets that have underperformed. This forces you to systematically buy low and sell high. It's a disciplined, unemotional way to harvest gains from volatility and reposition your portfolio for the next phase of the market. So, what does it mean to thrive in this new economy? It means shifting your entire perspective on risk. The future isn't a single, predictable path. It's a range of possibilities, many of which are extreme and unexpected. The anti-fragile investor doesn't try to predict the future. Instead, they build a system that is prepared for any future. Thriving means sleeping well at night, knowing that a market crash is not a catastrophe for you, but a pre-planned opportunity to increase your wealth. It means having the freedom and the capital to act decisively when others are frozen by fear. It means transforming market chaos from a source of anxiety into a source of energy for your portfolio. This isn't just about making money. It's about achieving financial sovereignty in an uncertain world. By building a portfolio with a strong defensive core and a highly opportunistic, speculative edge, you are not just hedging against the future, you're positioning yourself to own it. The economic tides of 2026 will be choppy, but they also carry waves of immense opportunity for those who are prepared. The anti-fragile blueprint isn't just a strategy, it's a philosophy for building enduring wealth in the 21st century. Start by assessing your current portfolio. Are you resilient, or are you truly anti-fragile? The difference will define your success in the years to come. Thank you so much for watching. If you found this breakdown valuable, make sure to hit that like button and subscribe for more deep dives into investment strategies that actually work in today's world. Let me know in the comments what part of the anti-fragile strategy you find most interesting. Until next time, invest smart.